For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. We are managing your financial future. Welcome back to the podcast. Happy to be here. I'm Johnny Dean, your podcast host. My thanks again to Richard Cook last week. Professor Plum, welcome back, by the way.
Thank you.
Good to have you here. Richard and I had a great time. He had not been on. I said it's been, we've been doing this podcast in this form for like 3-4 years, and this is the first time I'd had Richard Cook on.
Really? I thought he'd been on before.
No, he had not. And I looked, I said, my gosh, we got to get him on. So the schedules worked out and it was good. We talked about 4% rule and how it's really just a guideline and how it sort of applies to your income and maintaining an income, a steady income throughout retirement.
It's a useful tool for planning from a high level amount to try to get an idea of what can and cannot work. But it's not a hard, fast rule that shouldn't ever be broken and always be applied just as specific 4%.
Exactly. And I said, Richard, you and Plum talk the same language. I mean, everybody's kind of on the same page, which is good. That's what a team should do. But along those lines now, as we were talking last week about creating an income and having a steady income through retirement, and one of the reasons that you hire a financial advisor, according to the research that Richard had given me, was that you want to make sure you don't run out of money. That was like the top reason.
Kind of a key for a retiree, yes.
I would think so. Don't want to run out of money.
Right.
So that's where that discussion came about. And this, of course, is driven by what we talk about from time to time, and it's time to discuss it again, and that's the bucket strategy. The bucket strategy, which aims to keep you from running out of money before you run out of time.
Right. It's designed to try to create a stable, predictable cash flow that you don't, and it also is designed to help on the behavioral finance side, keep people from worrying about, oh my gosh, the market is crashing. Yes. What do I do? Do I need to sell everything and go to cash until it recovers? Well, and we don't know when. Well, I can tell you it's going to crash at some point. And what is defined as a crash? 20%, 30%, who knows? I mean, it's going to go down at times, and it could stay down for a little while. The problem is we just don't know when.
Well, and that's really the question.
Yes.
Tell me when. I don't care if it does. Just tell me when.
Because if we know when it's going to go down, we can avoid it and use that to our advantage. Go to cash, and then when it gets towards the bottom, because presuming that we know when it's going to be at a high point, we then must also know when it's going to be at a low point, and we can invest back in. The problem is we don't know either one of those points.
No, and nobody does. If everybody knew, then, and that's the thing that I've heard. If there were no risk, and if stocks were risk-free, well, then everyone put their money in, it would always go up all the time. And if it always went up all the time, that's an inherent risk right there, because eventually it's going to crash, creating the very risk that it supposedly didn't have.
But if stocks had no risk, they wouldn't have the return, and people wouldn't be investing in them.
Well, you would think. So I got to reading here an article that I had found, and this was a few years old. And I thought, if anybody wonders what the bucket strategy is and wants to look it up, and they go online and they find different things that describe the bucket strategy, if you put in something, certain search terms, you're going to get results that will tell you about the bucket strategy and say, oh, it's a gimmick. Oh, it doesn't work. And I was intrigued by that. So I was taking a look at a couple of articles, and I sent you one of them. And I'm sure the ones that I looked at were all about the same. Professor Plum, the criticisms that I've seen about the bucket strategy all hinge on getting the bucket strategy wrong.
Probably.
Getting the basic premise wrong. So I was looking at this one article, I think it was in Forbes, and it said, okay, so let's talk about what's wrong with the bucket strategy. Let me tell you how a bucket strategy works, okay? You take 2 years of safe money.
Cash is what
they said. You take 2 years of cash, and you put that off to the side. Then you take, if you want to have, you can put the rest in equities, but let's take the 3-bucket stance. And then you've got another 4 years maybe of 5, whatever it was, of semi-safe money. I forget how
Well, they were talking about
described it.
bonds and things of that nature.
Yeah,
Bonds and low volatility assets,
Right.
they called it.
And then the rest you put into equities. And the idea is that when the bear market starts and stocks go down, you rely on your cash to get through it to buy you time. Well, immediately, I knew what was wrong with that. 2 years of cash, 2 years?
Well, up until recently, the last two big downturns, 2020 and then 2022, typically the average length of a bear market, this is from top to bottom, not to recovery, is about 18 months. So it takes you about 18 months to get to the bottom.
Mm-hmm.
If all you have is 2 years worth of cash on the sidelines, you don't have a lot of wiggle room for getting away from the bottom and then having to sell some other type of asset.
Mm-hmm.
And so 2 years, in my opinion, of safe, stable, low volatility, cash flow is not enough. And
it's not enough. Yes, in your opinion, but that's a strong no right there.
So we think that you should have a little more. There were several things that he mentioned that I think were wrong with his assumptions of the bucket. One was the application of it, 2 years of cash, 5 years of fixed income bond type investments, and then the rest of it being stocks. And then what he went on to promote was a 25 cash or bonds, 75% stock allocation. Well, if you're using a 4% rule and you've got 7% or 7 years of 4%, that's about 28% available in cash. Now you got a 28, he's saying put 28% in, he was comparing the buckets and saying they're horrible, using 28% in safe fixed income type assets and 72% in stocks. But his asset being 75% and 25% was a better deal.
How?
Wait a minute, that's about the same thing. The only difference was he was rebalancing annually, which means he was selling stocks when the market was going down or at the bottom,
Mm-hmm.
where we were trying to avoid, even in the incorrect version he played with.
He was still doing it wrong.
Right.
Yeah.
The other premise he made was the idea is that it's simple. Buckets are simple.
Oh, that was the other problem.
And I'm
I had
thinking,
with it. Not if you're doing it right.
The concept is simple. You have X number of years. We like 5 to 7 years of cash flow in safe buckets. Right now, we can use T-bills and things of that nature and get 4% plus in that area. And then you have another bucket that refills that bucket when you run or get close to running dry. And so you're building time horizon for the stock market.
Yeah.
The debate for the buckets isn't necessarily that you should or shouldn't have buckets 1, 2, and 3. It's how much time should each bucket be prepared for. And that's where the debate comes in, where the comes in the buckets. The idea, though, is it's simple, no, because now you have to actually manage it. You have to then decide, when do I rebalance from bucket 3 to 2, 2 to 1? What constitutes an overachievement in my buckets to trigger a rebalance? What triggers a downturn, and when do I try to take advantage of a downturn? So those are all discussion points, and unfortunately you can't just set a buckets plan up, set it and forget it like you can a systematic withdrawal from a balanced portfolio, where you just automatically with a systematic withdrawal, which is what he was proposing.
Yes.
A 50-50, and he was saying as much as 75 stocks, 25%.
This was the author of the Forbes article.
Saying this is a much better deal. Subscribing straight to the 4% rule.
Yeah.
And it's very simple. At the beginning of each year, you take out your 4% plus inflation, and then you rebalance to your original
so that you're back where you started.
So you're back where you started. Regardless of whether the market's high or low, you automatically have it done. This can be set up. This is really simple, folks. You can have a computer set this up.
Yeah.
And so you start with, we'll use $1 million for easy math. You can do any number you want. $1 million, you take your 40,000 out at the beginning of the year, the 960s left in a balanced portfolio, it grows. At the end of the year, you take another 40,000 out and you rebalance it back to whatever it was. And so you don't specify where that money's coming from. You're taking it from every piece of the pie in that balanced portfolio. And in years like 2020, maybe your year started in March of 2019.
Yeah.
And your 1 year was up in March, April of 2020. That'd
happened?
be a horrible time to rebalance if you remember what happened in that period of time.
Awful.
And then 2022 to 2000, you're really putting yourself at the whim of the market.
You're really in trouble if you did this in 2022, because I've read where some people say, well, look, okay, if stocks are down, just take it from the bond side, go to the bond side, and
but
take
if you're
money out
automatically
of that.
rebalancing, you've got to rebalance
Exactly,
and you're selling other areas.
Well, and what if you tried that in 2022 when bonds were also
bonds and stocks were down?
They didn't count on that. Now,
and the problem is the market can be more irrational than you can be rational. That's a complete screw up of a great quote. The market can remain irrational longer than you can remain rational. But it's a matter of it's very difficult to do things on automatic that work perfectly.
Yeah. So,
and the 4% rule using a systematic withdrawal, the way this gentleman was talking about, was just putting it on automatic and hope for the best. And I do say hope for the best because studies have shown that at times, that system works exceptionally well. And there are times when that system leads to a very premature distribution death of zero money left over after not a lifetime of income.
If I go to Las Vegas and I get lucky roll on craps, I can do exceptionally well. Much better than if I just sat around waiting for my stocks to grow. Yeah. All right. But it can also send it the other way. And that's the problem. The shorter your time horizon, the more gambling you're doing.
Right.
And what bothered me the most was not that, you can criticize. I mean, there may be some valid criticisms of it just based on people's goals, but to set it up incorrectly and then criticize the wrong setup is just wrong to me.
It's you set it up incorrectly, which almost dooms it for failure, and then say with a very broad brush, it's always going to fail. Well, you can do the same thing with the systematic withdrawal, too.
I would love to see people like that take our bucket strategy, the 5 to 7 years, and then another 7 years or so, and take that and say, okay, now tell me where it's wrong. Because they won't be able to do it the way they did with this one. The one criticism that I've heard, and it's not even a criticism, it shouldn't be, is that you're taking more money out of the growth area, leaving less potential for growth. You know what I mean? Like your bucket three.
We're moving a lot of money to bucket number 1
and 2.
We're becoming more conservative. If you do it with the longer time horizon of bucket 1 and 2, you are more conservative than you could maybe otherwise get away with. And if the market goes straight up for the next 10 years, you would have done better by being more heavily allocated to equities. But do you want to guarantee me that the market's going to go up, straight up, or just continue on a positive plus every year and have no downturns when you're taking money out of the portfolio? I was looking at a slide from, I can't remember where it's from. I'm sorry, I can't give credit to it. But it talked about the return of each calendar year over the past 40, 50 years. And the low point at each calendar year. And in almost even the years where we had like a 15 or 20% year in the stock market,
were positive years,
as measured by the S&P 500, there was a negative of maybe down 10%, down 5%. So if you're doing a systematic withdrawal, at some point, even in a positive year, you're selling things at a negative. When you sell things at a negative, I don't care what the positive is after that. You're not there with that amount of money.
Big no-no. And I didn't see any of that mentioned either. So let's...
But I mean, there's been... buckets have been around for quite a while now. We started using buckets 30 plus years ago or so. And we were some of the first, I think we were the first ones calling it buckets, doing it time segmentation and things of that nature outside of the pension world. And at first people just kind of dismissed it as, well, that's kind of, it can make some sense, but it actually was, a lot of advisors didn't want to do it because it did require a little bit more work. It did require a little more contact, a little bit more with the clients, with what's going on. But now it's a very much more accepted. In fact, many of the big names in financial planning on the academic side and on the practice side are coming around, and they may not always call it specifically buckets, but the time segmentation, the allocating off of more than 2 years of safe cash flow so that you can withstand an unexpected downturn in the market. And also, is there ever a downturn that's not expected? That's expected? I mean, because
Well, we expect them, as you
we
said,
always
though,
expect them.
We don't know when it's going to be.
So the idea, a lot more of the academics are saying this works better.
Explain, if you would, for people, and many of our listeners probably already know this, but explain again, if you would, the premise of the strategy and how it can potentially protect you from the idea that you have to sell stocks when they're down.
Well, the whole thing is one of the worst things you can be doing is have to be forced to make a decision to either have to sell something that's down to be able to create the cash flow that you need, or decide to go without cash flow while the market's down. So one of the things that the market is going to give us that none of us can control, we have absolutely no control over the volatility of the market. It's going to go up and go down, and nothing I do, nothing you do, John, nothing anybody that I know
we
of,
can't do anything.
We can't change that. We also can't predict it very well. And so volatility is going to be there. So when we're creating an income strategy, now most people need to get some form of return over and above just putting their money into an account and withdrawing principal from a bank account. They need to get some, they want to leave money for their heirs. They want, I guess if you have $1 million and you want to take 4%, $40,000 a year out, you can do that for 25 years. You can put it in your mattress and make it last 25 years. But then at 25 years, you have nothing left and nothing to leave for your heirs. You would like to be able to earn 4% or more on average overall, so that your $1 million maintains and then grows, maybe to offset inflation that may be happening, to help your kids out, to have unexpected needs that sometimes require more than 4%. And you don't want just the 4%. You're trying to grow it a little bit, because things happen in the future. So the idea is that you want to have this cash flow that you need better than bank account rates of return, better than guaranteed asset rates of return,
like CDs or money markets,
but you also don't want to worry about having to put yourself in a position where you have to liquidate assets when they're in a negative position. Well, how do you go about doing that?
It's a balancing act in some way.
Right, and they work again. You want the rate of return, but you can't accept the volatility that comes with the rate of return when you want the cash flow. Yeah. And so which one's more important? And so the idea is, how do we make this work and not be Nostradamus and tell you, now's a good day to invest, now's a bad day to invest?
So you take 5 to 7 years.
The whole idea is the markets
not 2 years.
The markets do what they do. And when we look at historical downturns, how long has it taken to recover? Most of the recoveries, 5 to 7 years, some recoveries in 10 plus years. It takes that long. 2000 to 2009, S&P just recovered.
It's not, as you said, it's not just top to bottom. It's top to return to
top
where
to
you
recovery.
Were.
Yeah.
Get back to even.
And I like to from top to what could have I earned in a guaranteed account? Yeah. In a T-bill account or something. So I mean, if I can't beat it at guaranteed rate, why even take the risk? Yeah. So we've looked at it, and one of the worst areas was back in 73, 74, the downturn back then. It took 12.8 years to get back to even with what a T-bill would have earned. And so we look at having to help control our psyche, help control people from freaking out and doing, what the average investor typically does, the wrong thing at the wrong time for the wrong reason, help them overcome those fears. We want to have better than 12.8 years for a pure stock market investment to be able to withstand at least what we have so far seen as the worst case scenario out there. So who knows what the future is going to hold?
You need 12 to 15 years.
Right, but I don't necessarily want to have 12 to 15 years in a bank account, especially a couple of years ago when bank accounts were earning 0.0 %
I mean, you could, but
so we want to have.
You don't have to.
I want to have safe money and maybe some moderate money, and that's where the debate comes in. That's why, when he said it's simple, no, it's not simple, because we have to understand what we're actually trying to accomplish. Money I need this year, yeah, that can be in a bank account, money market account, safe account, online bank account. Money I need next year, maybe a 1-year T-bill. So even within the buckets, we can bucketize the buckets. And so
to give you maybe a little bit.
Yeah, trying to get as much return, trying to get as much juice out of that orange as we can without changing it to an apple. You know,
No, that's true, because what you're trying to do is buy time for that bucket 3, for those
Right.
equities. Just let it simmer in the oven for that long.
so we're looking at, in general terms, bucket number 1, we want to have safe, low volatility, distributable cash. That's for the next 5 to 7 years. Then we have another account that we know we don't need to touch for, let's call it 7 years. So because I don't need to touch it for 7 years, I can take a little less liquidity, or I can accept a little bit of volatility, not the same volatility as the stock market as a whole, but maybe a little bit of volatility to get a better rate of return than what a guaranteed account may be able to give me. So I get a little bit better, a little more juice out of bucket number 2. And then as it gets closer to the time horizon of bucket number 1, as I start getting close to being empty on bucket number 1, I transfer bucket number 2 into a new bucket number 1 to buy myself another 7 years worth of time. So I'm getting past that 12.8 year horizon that was the worst case scenario back in history that we've seen so far. So I'm getting closer to a better predictable, higher confidence rate of return out of the stock market. So then the rest of the money, I've put the money in bucket number 1 to give me the 7 years. I put bucket number 2 that can then turn into bucket number 1 for another 7 or 8 years. Now the rest of the money is in bucket number 3, which is a pure stock growth portfolio. And I have a very high confidence that it's going to outperform, historically, that's been 9-10%, give or take. Maybe it's, you projected at only 7 or 8% to give yourself a little bit of wiggle room there.
Yeah.
And the issue then becomes, I've got a very high confidence that I'm going to do fine in bucket number 3, but we're protecting against an unknown downturn that may or may not happen for several years. Well, what if the first year the downturn doesn't happen, but we get a year like 2020? Well, the whole year of 2020 was a positive 20% in the for the S&P.
And 2021 was even
almost
better.
30%.
Yeah.
What if my first 2 years are 20% and a 30% like we saw in the last couple of years before this downturn? Is that where, well, this doesn't work. Let's take all our safe money and put it in the stock market. It's on fire. Let's go. Come on. That's where you look at it and say, I have protected myself against a downturn, but I'm protecting against negative volatility, but I received positive volatility. Let's take some of that excess return. I was expecting an 8-9% rate of return, 10% rate of return.
I got 30 or 20.
I got an average of 25 over the last 2 years. I've got 15% per year to the good. I'm way ahead of where I thought I should be. That is a discussion point that doesn't happen automatically, but you have a discussion with the client, with the person, the investor. Do you want to take some of that cream off the top?
And buy yourself a little more time?
Well, buy yourself a little more time, or create some dry powder.
Just
so
in
that
case for
when, whichever way you want to look at it, the market does go down. Now you're looking for an opportunity on the other side. Now, when the downturn happens, not only have you protected your cash flow from it, but you have the opportunity to take advantage of that downturn.
You got to sail.
I don't know when it's going to actually be the bottom, but if the market's down 25%, that's a better time to buy in than the year before when it was, higher by 25%.
It's a better bargain. So obviously, I mean, that's where the management of the bucket strategy comes in.
And it takes a little work.
And it's not simple. So when you do a bucket strategy versus this systematic withdrawal that this person of this article was promoting, what are you giving up? You must be giving up something. I mean, nothing. There's a cost to everything.
Well, if the market goes straight up, you are giving up something.
Rate of return.
You're giving up potential ending value. If the market goes positive, you just 10 years, like we've seen long runs where the market was positive plus every year more than expected. And then at some point it turns around. It happens.
It's cyclical, of course.
Yeah. But if you know, or if you want to take the chance that the next 10 years are going to return nothing but positive returns in the stock market, the buckets will hold you back. Because
from a rate of return,
from an overall ending value standpoint, because we're not 100% in the stock market. We're, for a retiree, we're talking about.
So that's the cost.
That's the cost.
That's the cost. Now, the question is, are people willing to pay it? Because retirees, by and large, are less concerned with
ending value,
and it's more like, can I have my income no matter what?
And I may have misstated. It's not that they're not concerned about the ending value. They're less concerned about becoming ultra rich or significantly richer than they are now. They're more concerned about becoming poor.
Well, really, I've heard the key to investing is just not screwing up.
That's a very big
Right?
issue for the average investor.
I mean, think about it. That is not consistently screwing up.
Yeah. I mean, it's hard because the emotions, we get very emotional about investing. I can't, people, buy a stock and it goes down and it's like, oh man, the stock's a dog. Well, sell it and get in something else. I can't sell it now. It's down. I got to wait for it to come back. Then I can sell it. It's like, would you buy it now? Well, no, then why are you keeping it now? This loss. I got to make my money back.
I've heard that you can't panic in investing, but if you're going to panic early. Really. I mean, don't wait. If you don't like you invest in something, it's starting to go down. I'm too nervous. Let's get out. I mean, if you're going to panic, do it early, but don't wait. Don't wait, because really, you have to allow. Compounding takes time. I mean, look at any successful portfolio manager. You're going to find the ones that are the most successful are the ones who are doing just average returns
without bad losses
over a long period of time. Not the ones who are, up 30% 1 year and down. No, you want simply decent returns, above average returns over a long period of time.
Right. And it's the downturns, and because of the way math works. You lose 25% in your portfolio. It takes 33% to get back to even on basic math.
That amazes people when you tell them that. They say, well, wait a minute. If I lose 25% and I gain 25%, aren't I back where I was? No.
Well, no. You're not. Let's make it easier math.
Let's say 20.
You lose 50%. You have $100,000, you lose 50%, you're down to $50,000.
How do you get back to 100?
It takes 100% return on 50 to get back to 100.
Exactly.
And so it's just math.
No, it is, but that's the problem, and that's why the key is don't mess up.
Right. And you talked earlier about what's the cost. Well, the cost depends on what happens in the first 10 years of the distribution life. The cost is all about what happens, that sequence of returns in the first 10 years of your cash flow. Let's take a 65-year-old. What happens from 65 to 75 has a dramatic effect on the rest of their financial life. Because if they have a couple of 3-4 down years, and it doesn't have to be big down years. It doesn't have to be 2000 to 2002. That's a bad set of years. But it just has to be some down years, and you're pulling money out of the portfolio. That has a dramatic, detrimental, negative, how many more bad words can I say about this, effect on your portfolio? So what's going to happen in the next 10 years? Are you confident that you won't have any bad years? If you're confident that you won't have any bad years, then don't use the buckets. If you don't know what's going to happen in the next 10 years, buckets helps do that. Now, from a what's it really going to cost standpoint, I've talked about this before. I think it was John Hancock did a study years ago. Somebody retiring in 1969.
Mm-hmm. Yeah.
And they took a 5% non-inflation withdrawal distribution from a 50-50 balanced portfolio. S&P 500, I think it was Ibbotson or a bond portfolio.
100,000.
It was 100,000 to start with, took 5,000 a year out, 5%. And from 69 on, they just rebalanced it every year.
From 1969 on.
Right. Well, from 1969 on for just under 20 years, because they couldn't continue at the 20-year mark because there was nothing left.
And it was because?
It was because the early 70s had some, or the 70s had some down years.
Yeah.
That they were pulling money out of the market and selling it.
And they couldn't recover. Couldn't recover.
Compare that to somebody who retired in 1979 doing the exact same thing, 100,000 taking 5% out on a balanced portfolio. And by the end of 20 years, they had 500,000 left in the portfolio. And so
because they had some really good
because there were no down years in the first 10 years of the 1980s.
Now, Buckets aims to avoid both of those scenarios.
Right. And so I've gone back into that and said, instead of using a balanced portfolio as such, let's use their concept. Let's use a balanced portfolio, but let's not take any distributions from it. Take $5,000 a year. I want a very simplified issue. I want 10 years worth of cash flow, more than what we normally would do from this, but 10 years worth of cash flow. So I'm going to take 10 years of 5,000. What's that? $50,000. And I'm going to take it out of the balanced portfolio. I'm going to put it in cash. and I'm going to put it in a non-interest bearing account, and I'm going to spend $5,000 a year out of it, earning absolutely nothing, and leave the other $50,000 in that same balanced portfolio that the first person that they used.
In other words, you're sort of bucketizing.
Well, yeah, but I'm using a 2-bucket approach. And I would say that would be considered more conservative, would you not?
Yes.
50% of it in a coffee can and 50% of it in the same portfolio. And then at the end of 10 years, when my coffee can is empty, I take $50,000 out of the balanced portfolio and put another 50, and put it back in the coffee can and do it again. So would that have helped the person from 1969? Yes, obviously it would have, because they would not have been selling something when it was down. They allowed the 10-year time horizon to recover. And the reality was, at the end of the 20-year period of time, where if they used the balanced portfolio 100%,
they're out of money.
But if they used the more conservative approach, they still had $102,000 in the portfolio.
After 20 years.
After 20 years.
You've done the math. So that's
I've
where
done the math,
these
yeah.
numbers have come
But
from.
what did it cost? I'm getting to the cost.
Yes.
That's what helped them in the down years. But what about the good years?
What if I'd done this in 1979, where I had a lot of money left over simply by doing a systematic withdrawal?
I took it out 30 years.
What if you bucketized that?
I took it out 30 years. So after 30 years, the person who did just the balanced portfolio, systematic withdrawal, had around $600,000 in their portfolio.
Not bad.
Very nice.
Because they had some good years in there, sure.
Right. And the person who did the more conservative bucket strategy, the cash and then the same portfolio. We're using the same portfolio. We're not
simplified.
I'm not using all stocks or anything else. We're using the exact same portfolio. They did not have $600,000 in their portfolio. Obviously, they were more conservative, and the markets were good.
What'd they have?
About $500,000.
Wow.
So, yeah, you lost out on that $100,000 or so of potential growth that you could have had.
I would hope that you felt a little better mentally by having, because you don't know what the next 20 years are going to bring. And that's the whole point of doing that.
And I will be honest, I did cherry pick this a little bit. I went to 30 years. Why did I go to 30 years? Because what happened in 2000, 20 years into the first 20 years from...
Oh, we were at 1999,
right.
2000.
Those were great years, but the next 10 years were horrible years.
Wow.
So, yeah, I'm cherry picking. And I'm showing...
How was it after 20? Do you remember?
I don't remember the numbers. It wasn't as... It was still... You still had a decent amount of money left over. So it did cost you if you couldn't predict the future.
Yeah.
So for all those people who can't predict the future, you probably want to use buckets. If you can predict the future, you can go ahead and be more aggressive.
Anyone can predict, but you have to be right. I've made plenty of predictions, and it just doesn't.
Well, and
pan
some
out.
of these people that make the predictions and they write books about how they called the market top, and they were right about the oncoming downturn.
Yeah.
They
made predictions every month.
They've been calling for it to drop forever.
Yeah. Oh, yeah.
And they finally were right.
If I say it's going to rain often enough and it does rain, I'm going to be right.
Oh, one day, yeah.
Yes. Oh. Okay, so that's our discussion here. I hope this has been helpful to people. We talk about buckets peripherally, and sometimes, like today, we talk about it
a little more in depth.
A little more in depth, only because, as I said, with Richard Cook on last week's program, we got into it a little bit and talked about income. But it's important to understand that when you're looking around online and you're trying to do your research, which you should do, absolutely, remember that some of the things that you read are skewed and may not be correct. Let's put it that way.
Very much so.
If you have any questions about bucket strategies, if this particular episode has not answered them, feel free to hit up any of the Lucia Capital Group advisors, including Professor Plum. 800-644-1150, the number at Lucia Capital Group, 800-644-1150. You can also find articles at luciacap.com, luciacap.com. You've done a bunch of videos on buckets, and there are different things you can read. I would encourage you to read as much as you can if you're unsure about buckets or how it works. But the folks at Lucia Capital Group, as you said, we've been doing this for 30 years at least, I would say, for a long time. So there are a few scenarios that we haven't seen, but there may be something out there. Who knows? Give them a call and talk to them. Professor Plum, I should have said you're a certified financial planner, CFP professional.
That's right, you didn't.
Certified financial planner, professional certified. Yes, yeah.
With a little R circle.
Yes, registered. Put the little registered trademark next to that CFP professional. Thank you so much. Nice to have you back.
Thanks, sir.
Yes, we'll be doing more. As I said, if you have any questions, certainly you can email us and we'll try to answer them as best we can. For Professor Rick Plum, I'm your podcast host, Johnny Dean. Thanks so much for listening. Talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Money market mutual funds, though traditionally lacking federal insurance and not without risk, are highly regulated under federal law. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Rick Plum and Richard Cook are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.